Robert Omotunde, acting head of research at AfriInvest, joins me now. Good morning, Robert. Thank you so much for coming through.
Good morning, Harriet. Thanks for having me.
Well, give us a sense of how the financial markets, especially the fixed income segment, is reacting to the data released by the Statistics Office yesterday.
Well, of course, market had expected some of the, if you like, bad data that we experienced, that came in yesterday. So we had expected that inflation was going to come in higher. Of course, we saw it inching higher to 17.1% from 16.5% earlier reported in June. And of course, the outlook for inflation is still very bearish, as we expect that inflation will hit 20% before the end of the year. Of course, the market was, in anticipation of that, had been pricing fixed income securities at a very much more higher yield. So what we saw yesterday was not so much of market reaction, because if market was really to react to 17.1% inflation, we should have seen at least about 100 basis point movement in yields. That did not happen yesterday, so which suggested that market probably priced in a lot of this expectation into the market.
But then, Robert, we saw mostly lackluster trading across the fixed income segment of the market, even though we know that the Central Bank of Nigeria did a Treasury bills auction yesterday.
Yeah, true. And the reason is simply because, of course, because of the auction, what you get at the auction is usually higher than what the secondary market will trade. So what we've seen is a lot of rush by most investors who wanted to take advantage of that market to place their bids at the primary market window, where they can earn much more higher yield, maybe on the average about 50 basis points higher than what you would get at the secondary market. So what we saw yesterday was actually expected, because of course the auction was going to allow most investors to be able to get higher yields.
Well, Nigeria's sovereign dollar bonds fell across the curve to their lowest level in more than 2 weeks yesterday, after the MBS data showed the economy contracted by 2.06%. Was this expected, and is this something to worry about?
Yes, for foreign investors, they are much more reactive to macroeconomic data. And to be frank, because where the our euro bonds are trading, they are trading on the London Stock Exchange. The market is a little bit more efficient than what you get here. And again, no foreign investor wants to think about sovereign risk or risk associated with their investment, and we don't want to take proactive action. The reason why we saw some form of stability at the domestic front, like I said earlier, was mainly because, of course, the major buyers of fixed income instruments in Nigeria are the local institutional investors, PFAs, insurance companies, the banks. I mean, maybe a few HNIs. So, but what we experience at the Eurobond market will be much more proactive reaction to data, because of course they have to price in the new risk into their investment, and the possibility that, of course, the economy is contracting. A lot of banks who have issued these Eurobonds may be falling short of their obligations. If the economic activity is not as smooth, then the financial service sector is also feeling the heat, because that's at the center of all economic activities in the country. So what we saw at the Eurobond market was also quite expected.
But then, despite the gloomy numbers, the federal government is optimistic of a better second half, and investors seem to also want to buy into this idea. Do you think it will calm investors, the fact that the federal government says the second half of the year will look better, it will improve, despite where we seem to be at the moment? It's very scary, if you ask me.
Yeah, actions speak louder than voice. So in our view, we would think that for us to see significant improvement, the action of government at the moment may not be suggesting that we will see a breather in the second half. We had earlier expected that the second half was going to be better, but the handwriting on the wall would not make us go bullish even on the second half. Maybe the government, in terms of, there should be some form of regulatory breather. It's like regulation is choking the industry, and we should begin to see some form of regulatory breather and some form of proactiveness from the angle of government if we should see any recovery in the second half. For now, our outlook is still bearish for the economy.
Robert, let me quickly take a line from the statement we got from the Office of the Vice President yesterday in reaction, of course, to the slew of data that came out from the National Bureau of Statistics. The statement in part says the presidency will continue to work diligently on the economy and engage with all stakeholders to ensure that beneficial policy initiatives are actively pursued and the dividends are delivered to the people, to the Nigerian people. That's also something I know that foreign investors will be taking a look at, and taking a look at, of course, at the data from the National Bureau of Statistics. We saw FDI coming in relatively low from what was recorded in the first quarter of the year. We saw FDI at $133 million, FPI at $245.3 million. How significant do you think these numbers will be affected in the coming days, going by the statement from the Vice President's office that they will continue to engage relevant stakeholders to ensure the policies, the initiatives that they've started to look at become a reality?
Well, the truth is that there's no policy manager, monetary policy or fiscal policy that would not make positive statements to sort of ease the tension in the system. But the truth is that most investors are not just interested in those statements, they are more interested in the actions. So it's good that there are statements that suggest that government is committed to making us, to getting us out of the current economic situation. But there needs to be actions that also support this statement, and that is what foreign investors and even local investors would see before they take major steps in investing in Nigeria.
Robert, it's the first trading day in September. What are your expectations? Do you expect market sentiments to be cautious or tepid? Who or what is going to move the markets?
Market is going to be very cautious. Let's look at it from the equities end. Because the yield environment is still very attractive. Inflation figure at 17.1% is not going to help this any further, because we would expect the yield environment to be much more higher. And to that extent, most investors would rather do fixed income than play in the equities market. So for equities market, what we are going to see will be more of investors trying to take opportunistic positions. They will want to check when the market is pretty low for them to come in and then go out when the prices go higher. So more of technical trading, that's what we'll say.
All right, thank you so much, Robert, for your perspectives this morning.